Chapter 4, 11A in your textbook, we have George Clausen, who is 48 years old, and he is employed by Klein Company and is paid a salary of $42,640. He's just decided to join the company's simple retirement account and has a few questions. So a simple retirement account basically is if your company has up to or less than 100 employees, they can offer kind of as part of their 401k plan. It's called a simple plan, and it's similar to an IRA. So what it does is it allows the employees to contribute a percentage of their pay towards their retirement. So basically for a simple IRA, the 2012 maximum employee deferred contribution is $11,500. So for A, his maximum contribution, it's $11,500. That's the maximum he can contribute based on the IRA regulations for 2012. Now, if he was age 50 or over, he could offer $2,500 in addition to that. And an employer must match an employee's contribution up to that amount. Okay, so since he is only 48, his maximum contribution is going to be $11,500. And so the company's contribution will be 3% of that, which that's where the $1,279.20 comes from. So C wants us to take a look at what his take-home pay would be if he made the full retirement contribution. Okay, so his weekly pay is $820 because we took his $42,640 divided by 52. We got 820. His FICA tax was based on that 820 times the 4.2%, and the high portion was 820 times 1.45. Then we want to figure out what his federal income tax is. So you'll notice here that it says $820, which is his weekly pay, minus the $221.15. So what happens, that $221.15 would be if he contributed the maximum of $11,500 and you divide that by 52, that's the $221.15. So the thing about this type of investment is it's not subject to federal income tax. So even though his paycheck is $820, if he contributes that $221.15, his tax is only based on the difference of $598.85. So then you have to go to the wage bracket tables, and it tells us in the book, let's see, it tells us the wage bracket method, and then he's married and has 2 allowances. So we go to the weekly pay, married, 2 allowances, and then find this amount, and it shows that his federal income tax withhold should be the $29. State income tax, however, is based on the full amount, so it said 2.3% in your text, so that's $1,886, and then the retirement contribution, the $11,500 divided by 52. So his take-home pay ends up being $504.66 after we subtract all of the taxes. Now D wants us to look at what his take-home pay would be if he did not contribute. So if he did not contribute, he would have no federal income tax savings. So you can see that his federal income tax is $62 here, whereas it was $29 up here, because he's being taxed on all the $820. So the rest of the tax calculations are the same, and his take-home pay ends up being $692.81. So you'll notice that the difference between the $692 and the $504 isn't $212.15, because there was a tax savings up here. There was a tax savings up here because if he contributes to the IRA, that $221.15 is not subject to federal employment taxes.